So when it comes to investing, I'm really conservative. And I learned this from my dad, and this is my concern with this strategy, or pretty much any strategy. I remember the dot-com bust and my dad losing his shirt, and that whole strategy of just not wanting to lose money. I'm that same way, and my fear is that I'm trading in this wild market and I could lose my shirt as well. So how do you guard against that with your strategy?
You know, this is one of those questions that hits me pretty close, because I went through all of that in the dot-com era as well. In fact, I was in a company that was in the transition to becoming a dot-com. I was working at Encyclopedia Britannica at the time, and Britannica had recently been bought by Jackie Safra, a Swiss banker, billionaire, and we were in the process of teaming up with Mark Andreessen and Ben Howitz that were starting a firm called LoudCloud, which subsequently was bought out and doesn't even exist anymore today. But think of it as like the early days before Amazon Web Services, and it was a cloud web management software. And we were back in that, going back and forth with them, and both of us ready to launch our particular companies and had stock options in each other. And it was a very fun time, and I was drawn into that. I was in my late 20s at the time, and going through that process, and it really just, it was both exuberant and it was fearful all at the same time, right? There was this just euphoria in the dot-com market where people just thought they were just printing money. I mean, you had companies that had nothing to do with an online presence, but they would add .com into their company name and rebrand themselves, and all of a sudden their stock would go up. It was a crazy period of time, and it turned out to be quite a bubble. Now, like anything, bubbles have good and bad. There's companies that did really well in that time and survived and are doing great today, but a lot of them collapsed in that pullback, in that dot-com pullback. And it was a long period. If you go back and look at the S&P 500 and look at SPY on the charts, you'll see that was a lost decade. It's the most recent lost decade we've had in the stock market. And for those of you that don't understand what a lost decade is when the stock market hits a high and then it starts pulling back and crashes, and it takes 10 years for the stock to ever get back up to the point that it was before. 10 years of going down. And if you think that this can't happen, well, it can, and it has multiple times in the United States. It happened most recently during the dot-com era. It happened to Japan, and Japan had not only a lost decade, but they actually had a 26-year-long decade, meaning that their market went down for 26 years before it ever recovered. So this is something that is really near and dear to my heart, because when I created this framework and this strategy, that was in the back of my head, because I went through that dot-com era. I went through a boom and bust. We hired hundreds of people, and I personally had to let those people go. Hundreds of people that I had to personally fire, right? And that was not fun when you're just sitting there in exit interviews 8 hours a day for 3 weeks in a row, firing person after person after person, knowing that their hopes and dreams are being shattered, and you're the one delivering the message. It's not a fun place to be. And so I really do take this very personally. And when I was building out this framework, that was in the back of my head. We've got to be able to perform in any market. We've got to structure this in a way that whether the market's going up, whether the market's going down, or whether the market's going sideways, that we're going to be able to recover and that we're going to be able to succeed in this framework. And so that's what's built into this at its core. It's not something that I'm afraid of, because it's something that I engineered around from the beginning, right? And the way that we do things with the options, there's only two strategies that we use. And one of the strategies does really well when the market's going sideways or when the market's going up. And the other strategy, it does really good when the market's going down. Okay? Now, ideally, Ideally, we want to see a sideways market. That's our best market. When the market's going up really fast, we'll make good money, but it's not our best market. And when the market's going down or crashing hard, it's not our ideal market either. We'll still generate profit every week, but we're probably not going to hit that 1% weekly target when the market's going down. We may only hit half of that, and we may have several weeks where we don't perform as well when it's in a down market. But the difference is we're still generating income, even in those downturns, even in those crashes. And so what you have is math that just works to your advantage. The framework uses math in a specific way called DCA, or dollar cost averaging. And so the way that this works is that if you're trading a position and that position starts going down hard, like the market crashes for an extended period of time, well, you still have that position open, and you're still every week going to be able to generate a little bit of money, right? Not a lot, because it's a bad market right now, but you'll still be generating some income even in those down markets. And when you're doing that, what you're doing is slowly, you're chipping away at that entry point in your position, and it gets lower and lower and lower because you're dollar cost averaging down with the profit that you're generating every week. And see, this is different than a buy and hold strategy. Remember, if you're doing investing, then it's really buy and hold. You buy now and you hold until you sell it. And I like to call it buy and hope, right? Because you're hoping it's going to pan out when you sell. But we don't build this strategy on hope. We build this strategy on patience and discipline and execution. So every week we're trading. We're not just waiting for the market, we're actively trading through the turmoil. And that's the phrase that I really want you to begin to get comfortable with inside of this framework. We use it a lot. Trade through the turmoil. You're gonna have turmoil, okay? You're gonna have periods when the market goes up. You're gonna have periods when the market goes down. You're gonna have periods when the market crashes hard. You know, as I'm recording this right now, it is January of 2026. But in February of last year, in 25, with a brand new administration and President Trump in office, he announced his tariff plan. And on February 19th, the market, well, let's just say it did not receive it well, right? The market proceeded to crash 23% over the next, several days and weeks. And it took over 4 months for the market to come back up. Now, that's just a small pullback. It's really not a crash. A 20%, 23%, that's a correction, that's a pullback, but it's not a market crash like we had in .com. But here's the interesting part about it. The math is the math is the math. And the math just works, okay? So here's what I mean by that. When we had that 23% tariff pullback, my account went up in those 4 months substantially. And what happened is about a third of the way through, or a little more, maybe about 40% of the way through that 4-month window, my account had already recovered. So it had already got back to where it was prior to the pullback. And from that last point, the next 60% of the way through that down period, where all the buy and hope investors are still waiting and waiting and waiting for the market to come back, well, my account was already generating profit. It was already repaid itself from where it was, and now it's going up. And that's what you find in this strategy. You'll find that whether you have a COVID style pullback where you're down for a couple of years, or just a quick pullback like we had in the tariffs, or even if you have a 10-year lost decade like we had with the .com era. In any of those scenarios, the math still is about the same. Somewhere in about the 33 to 40 to maybe 50% of the way through that period of time, because we're chipping away and generating profits every week, and we're dollar cost averaging as the market's going down, our accounts recover much faster than an account that's in a buy and hold mode. And that's where I put my comfort. That's where I take my confidence from about going into retirement. I mean, I'm 55, I'll be 56 pretty soon, and I'm not that far away from, those periods of time thinking about retirement, right? And I don't want to be in a position where my account could go down 50% and I have no control. In this framework, because we're generating weekly profits, even in that worst situation, right? Even in that worst case scenario of a 10-year market crash, I can still generate weekly profits. Now, it may not be as much. It may be, substantially less than I would make in a boom market, okay? But at least I'm generating profit, and that is very comforting for me going into retirement, right? Knowing that I can trade through the turmoil, knowing through that other people that are going to be down for an extended period of time, I might be down for a while, but more than likely, I'm going to be back in 35, 40, 50% of the time that they are. And by the time they get back to point zero, right? Because when it recovers, all that means is they got back to where it was. They're just back to zero. If you're down in a 50% crash in a buy and hold portfolio, and it gets back to where it was, well, what does that really mean? It means for those 10 years that you were down in the dot-com era, 13 years that the dot-com bust was, for those 13 years, all you did was claw your way back to zero, right? And I don't know about you, but that's not real impressive to me. I can't afford to do that. And so what we find is that, halfway through or less, typically about 35 to 40% of the way through that pullback phase, we're going to start entering into profit mode. And that just means that the magnitude of the drop is less, the duration of it is less, and during that drop, instead of just waiting, we're actually able to generate some profit and keep some money flowing in and keep the lights on. And that's why, for me, I put so much time into this framework and testing it. And it's one of the reasons why I feel so confident about it is because it's proven itself with the math. And it doesn't matter. Like, there's always somebody that is rather pedantic, and it's typically like the bean counter types, and they'll say, well, that's fine in the 4-month tariff pullback, but what is it gonna do in a 2-year pullback, like the COVID, or a 10-year pullback? But the thing of it is, the math is the math is the math. Okay, and it's really like 4th grade math. It's not a hard thing to calculate, and it's just about having the patience to stay true to the framework, having the discipline to trade every week, because this is the main difference here. We're not investors. Investors are drawn into investing because they don't have to do anything, quite frankly, right? They buy something and they don't do anything for weeks, months, years, and just hold on to it. It doesn't take any effort to be an investor. A trader, it's different. It takes discipline. We trade every single week. Now, you've heard me talk about only needing 1 to 2 hours a week, and that's true. That's all it really takes. Our average students are not spending more than that amount of time. I trade a lot of accounts. I've got multiple businesses. I trade business accounts. I have multiple retirement accounts. I've got 4 children, and I even trade custodial retirement accounts for my children. That's how safe this strategy is, right? When we talk about options trading being safer than owning stock, think of it like this. Would the brokerage houses that force you to even do a quiz to even be able to trade options because they too view it as risky, would they allow you to trade this strategy in your 9-year-old child's custodial retirement account if it wasn't deemed to be a fairly conservative strategy? The answer is absolutely not, right? And yet, we can. We trade it in business accounts. You can trade it in 401ks. You can trade it in Roth and traditional IRAs. I even trade it in a HSA, which is a health savings account. All of those things are approved. All of those account types are approved for the conservative approach we take with selling puts and selling covered calls. But like anything, there's more to it than just the tactic, right? If you're building a house, everybody builds a house with the same tools, right? Everybody uses a hammer and nails. That's the same set of tools. Those are the same tactics that we use in options trading, and everybody that trades options uses puts and calls. They all use the same tools. The difference is the framework, the blueprint, how you assemble the house, right? You can use the same tactics and do it in a way that's risky and that generates an inferior product, and have a house that is something that you don't even want to bring your own mother home to see. Or you can use those exact same tactics, the same tool, the same hammer, the same nails, and build a mansion that is fit for the cover of a magazine. The tools and the strategies are the same. It's the framework and the blueprint for how to implement them. And that's what low stress trading provides. It provides that framework, that blueprint, and that guidance that allows you to follow it and stay within the discipline and be patient. When there's turmoil in the marketplace, to be patient and just follow the framework, stay true to the blueprint, don't try to improvise, right? And just stay the course, trade through the turmoil.
Hey, Troy here. What I just shared is just the tip of the iceberg. If you want to see the complete framework and how all of the pieces fit together, sign up for my free masterclass series. It's so low stress you can do it in 1 to 2 hours a week. So low risk the government allows you to trade it in custodial accounts for children. And so effective it targets up to 68% returns per year. Just click the link below and I'll walk you through everything.